Thank you for joining the webinar today. My name is Justin Fry, and I'll be the host for the webinar. Housekeeping while people join the event. Questions, we'll have a Q&A session at the end of the webinar. You can ask questions at any time using the Q&A button at the bottom of the Zoom interface. During the webinar, we'll hold a number of polls and would very much appreciate your participation. If you should have any technical issues with the webinar, please use the chat button to let me know. A recording of the webinar will be made available later this week. A bit more today about the topic and the presenter. Our topic today is best practices for futures, how to succeed with futures market data. Our speaker is Scott Mayster, who is the Global Product Manager for TickData. Scott joined TickData in March 1999. His responsibilities include managing the TickData product line, including running day-to-day operations, developing new products and tools, marketing and sales. Mr. Mayster began trading while a student at the University of Wisconsin-Madison, where he received a BA in economics. Early on in his studies, he became enamored with the behaviors of the market participants and their effects on the financial markets and the overall economy. He received an MS in financial markets and trading and finance from the Illinois Institute of Technology. One Market Data is known for two of the main product lines: OneTick, which has a time series database, analytics, surveillance, and also areas such as transaction cost analysis and best execution. TickData, represented today by Scott, is known for historical data and reference data.
Thanks very much, Justin, and thanks to everybody for joining today. Very happy to be here to talk about TickData's futures data and some best practices that might help you use our data or any historical data. As Justin said, we have two main brands at One Market Data. One Market Data has been around for about 18 years. On the left side of the screen in blue sort of represents the TickData side of the business, which is the data-only sort of raw data access. Hesitate to use the term raw data because we do clean the data and transform the data and normalize it, but it represents global exchanges, trades, quotes, market depth, historical and daily data, reference data, corporate actions, dividends, the like, mapping, things like that. But as you move sort of towards the one tick side, you start to apply some of our analytics, and we can offer enhanced data, pre-computed bars, pre-built data, things like NVBO, aggregated data, and more. And then as you move to the right side, you see the full one-tick analytics solutions and real-time capabilities. And these can include marrying historical and real-time data and market solutions, as Justin mentioned, RegTech, things like trade surveillance and BestX. And today, we're here to talk more specifically about the data, the futures data.
Thank you, Scott. Before we embark on the main part of the presentation, I'd like to ask people a few polls. So please take a moment to familiarize yourself with the Zoom interface. Are you, first of all, a customer, a current subscriber, a non-customer user for historical data? Are you, in fact, in the market or soon to be in the market for historical data, or are you just looking around today? So please take a moment and answer. Thank you so much. Now, poll two, last of our polls as we start the webinar. What kind of organization do you represent? Are you from a hedge fund, asset manager, family office, a prop shop, bank, sell-side broker, academic, regulator, vendor, or something else entirely? Thank you so much for participating in the polls. And now I'm going to hand this over to Scott, who will do the majority of this presentation.
Our clients represent many different types of market participants. There are a wide range of people who I hope will benefit from this presentation. Users of futures data currently, our TickData clients who want a little bit more insight into how we do things related to futures data. Traders, analysts, market participants who are considering TickData or some historical data provider. People who are new to the futures markets are probably going to learn quite a bit, and even highly experienced futures traders will hopefully gain some insight from how we handle futures data. Next slide, please. A very quick introduction to TickData. We started in 1984 in Colorado. Two brothers, a futures broker and a programmer, saw that traders were starting to use computers to build and execute trading models, and thought that they could build a system for collecting this data and making it commercially available to to traders and analysts to build these models and backtest them, optimize them on the historical data before trading them in real time. And that was really the beginning of paper trading in those days. And they thought they could make a business of this. And you can see our very futuristic logo at the top right from back in those days. We were the first company to make this kind of data commercially available. And since that time, our offerings have expanded to include global futures, global equities, spot forex, options, crypto, and other asset classes. Then in 2015, we were acquired by One Market Data. Next, please. So if you're a user of historical data, why choose TickData as your data provider? The main reason for choosing any provider would be quality. Research quality is how we term our data. This means the data is never collected off a live feed. It's sourced from top-tier data providers and exchanges who can provide this data to us in end-of-day dumps of data so that we don't have to collect off of a feed. So you don't have communications issues or problems with sending data over the public network and dropping packets and the like. Then we have an extensive validation process as well that we perform every night, programmatically and also visually. And we have had, over the years, thousands of customers who have used this data and provided feedback, and we've made tens of thousands of fixes to the data over time. So the data has been combed through quite extensively. Also, our industry-leading support, because no matter how hard we try, no data set of this size is ever going to be perfect. So our support team works with our engineers and our data team to fix any problems that arise. Or in many cases, especially now after all this time, to explain what you're actually seeing in the data, why it looks the way it does, and if it's not an issue, then we'll tell you it's not an issue and this is why. Data delivery, another very important value add. We offer a wide range of data delivery methods to suit a wide variety of use cases. We have, as I said, clients from all different types of firms, and we want to make sure that we provide this data in a way that is best suited for their use case. And that really lends itself to research-ready data as well. Clean and complete data with metadata means less time spent verifying and preparing the data for use. Even formatting, we can handle that. And we provide tools to make that very easy for you. And the build versus buy, rapid onboarding, we say that we're able to provide data in hours to days, what would otherwise take months or years to build. So from that standpoint, it's a very compelling value prop. So more specifically about futures data, and I say here from One Market Data, not just from TickData, because there's a very wide range of data that is available from both TickData and our parent company through TickData. On the TickData side, we say we offer historical data, intraday data for more than 260 actively traded futures contracts traded on more than 30 global exchanges. That includes trade data as far back as 1974, tick by tick, and quote data as far back as 2010. This includes all actively traded contract months for any single day in that time period. You'll see all active contract months and millisecond timestamps. This has changed over time as technology has improved, but for the last at least 12 or 13 years, it's been millisecond timestamps. And our data can be delivered in text files. What we call our deep history, our source data files, our comma delimited ASCII files. And they can be delivered through our TickWrite software and through S3 Sync from AWS or our API, Tick API. In addition, our data offering is augmented by One Tick Cloud's data offering that adds all root symbols from more than 40 exchanges. So you get a few more exchanges and more actual root symbols. So these are going to be less heavily traded because we really focus on the more actively traded contracts, but we can provide all of them. And we can also provide level 2 data for some exchanges and spread data for most exchanges. This data is delivered in ASCII through S3 or through API or through One Tick archive files if you're a One Tick user. And a word on TickWrite, because I mentioned TickWrite above for the TickData offering. It'll be mentioned a few other times through this discussion. For those of you who are not familiar, TickWrite is our client-facing data management software that allows for data downloads and for building custom formatted time series files. There's some clips from a previous webinar on the OneTick website, onetick.com, that discuss its features and functionalities in more detail than I'll go into here. But of course, we're always happy to have a phone call with you to talk more about TickWrite or any of our other data delivery options. I also wanted to mention historical calendar information. Calendar info is an add-on product to our futures data that provides additional data, details about the futures data. This is something that over the years had been asked, we've been asked by customers many times, and we finally said, well, we have this information, so let's productize it and make it into a data set that clients who need it can license from us. They don't have to. And certainly if you're using TickWrite, you don't need to have this information because all this information is in TickWrite and TickWrite uses it to build files. But if you're databasing the data, if you're doing things with the files outside of TickWrite, it might be good to have this information in plain text. This includes a calendar of all contract month start and end dates. It includes historical session and trading hours, which is big because this goes all the way back as far as the 70s. Anywhere we have data, we have the trading hours all written out. And also historical holiday calendar details, including late opens, early closes, market closures, and large interruptions in trading due to natural disasters and global events are also included in there. Again, could be very useful for working with the data. TickWrite can be enabled to write out calendar info files in plain text, and then it can also be downloaded via S3 Sync as well. So with that said, I'd like to talk a little more in detail about some best practices for using historical data. I'm going to show this in terms of TickWrite output, but this can really be used with any futures data. And it's just a little bit more information about how we handle futures data and the things that we do to make futures data more useful to our clients. So because we offer various asset classes and they all have different financial functions, these different types of data have very unique characteristics. And in the case of futures, one significant characteristic that we have to deal with if we're using this data for analysis is the way contracts expire. They're going to expire in the real-time data that you're using during your trading, and so you have to figure out how to do this in your analysis. So futures contract expirations, namely, limit the ability to analyze futures data over long periods of time. So we can create files of continuous contract data to allow for longer-term analysis. Otherwise, depending on the contract, you could be looking at just a month of data for an active contract or a few months of data, and then that contract will expire, or even before then it will start to drop in its liquidity because traders have already rolled over to the next front month contract. So we talk about rollovers, and they occur when a front month contract, which is the most actively traded contract, approaches expiration. At that point, the traders holding these positions in the front month need to move their positions to the next front month. And so in order to do so, they're going to basically perform a spread trade. They're going to, if they're long one contract, they're going to sell that contract and they're going to buy the next front month contract. And so analysts must replicate the rollovers in their historical data. They have to roll their data from one front month to the next. So using our TickWrite software, it's really easy to do this, but it's also not all that difficult to do that programmatically, to write some simple code to do it, or even to do it in Excel by lining up contracts next to each other and doing it. Next slide. Let's take a look at an example of what a rollover looks like. Here we have the E-mini S&P, the ES contract, rolling from one month to the next, from the March to the June earlier this year. So on the left is the TickWrite main job window, and you can see the settings that are used for. We're looking at futures trade data. We kind of work our way from the top to bottom in TickWrite. These are futures trade data. We're looking at ES, E-mini futures. The interval is tick by tick trades. And then we have the continuous contract settings in the middle there. The contract is set to most active, continuous file. And then there's a roll method. You can see the adjustment is set to none. And just for this example, I looked at the month of March to see when this would roll. There's a whole bunch of other settings, but they're not really relevant for what we're looking at now. But what we see on the right-hand side is a snippet of the data, because I did this tick by tick, but you can actually see here in the box where we roll from the March to the June contract. And that happens on the 12th of March. So you see that the day closes at 4 p.m. And this is Chicago time, and then reopens for the next trading day at 5 p.m. 1700. So let's go to the next slide, and we can take a closer look here. On the left is the same continuous contract, but this is written out into daily bars. And this clearly shows where this rollover happened. I also included daily volume and daily tick count. On the right, we can see how this was derived. At the top, you have the March contract daily bars, and these will just keep trading. And you can see that the volume and tick count start to fall in the March contract as they start to pick up in the June contract. And that happens on the 13th. It exceeds, and that's when it rolls. So as I mentioned, we had some settings on the last page about rollover. And I'll talk about that on the next slide. But suffice to say that we look at daily tick count as the time to roll. So when the daily tick count of the next contract exceeds that of the current front month, it's going to roll to the next contract. Next slide. So TickWrite offers several roll methodologies here. Our default roll method is auto roll. And as I said, it compares the daily tick count of two contracts to determine which is more active. So why do we use daily tick count instead of volume? And keep in mind, there are many different ways that you can choose when to roll. A lot of people use first notice date or some official date from the exchange. For some contracts, it happens simply because of the nature of the contract. The bonds, you can be delivered in the contract month, or there's no limits in the grains, things like that. So we use daily tick count because our data actually predates volume. Real-time data never showed volume in pit trades. And if you go back into the 80s, the 90s, the 70s, there was no electronic trading back then. There was no volume in intraday data. But you can assign every tick a volume of 1, which would be the tick count, and sum those up for each day and have a very highly correlated proxy to volume. So we use daily tick count, and it's extremely rare that it does not match up to the volume, and it's certainly close enough, for the use of rollovers. But all of our clients, of course, are welcome to use whatever methodology they want. So TickWrite can also roll on expiration, days prior to expiration, date, days after inception. Days after inception is unique to, I think, a few Chinese contracts that actually count some number of days after the contract starts trading, and that's when it rolls. So we've basically put all of these different roll methodologies in TickWrite to give a lot of options. And while auto roll is the default, it's not always the best one. We have a page on our website, and it's under resources, that gives recommended roll dates, and you can download a file that has our recommended roll dates, roll methods for all of our contracts. You don't have to use these. They might not be ideal for your particular use case, but we were looking to maximize the volume or tick count for these rollovers. And in some cases, because they're thinly traded, just to get them to roll at all. And you'll see on there that actually some, especially some new contracts, don't have a roll methodology because it's too thin to actually roll. And in those cases, really nothing we can do about it. It's simply not enough volume in those contracts to roll. So TickWrite also provides a choice of which contracts to compare to the front month, the next contract or all contracts. So there was a setting that was most active that you can see there. There's also an option for front. And that, when you set your contract setting to front, TickWrite will only compare the front month to the next or nearest contract, which means if you're an HMUZ contract cycle, it's only going to roll from H to M, from M to U, from U to Z. It will only look at the next contract. But you can also select most active, and it will compare the front month contract to all contract months. And this is, I'll show an example, and you can see why this is useful. But the idea here is that if you don't want to just go sequentially from one contract to the next, this will skip contracts if there's another contract further back that has a higher daily tick count than the nearest contract. So when the daily tick count of the next contract, the front or any contract in most active, exceeds the daily tick count, that's when it rolls. Next slide. So here is an example of where most active is more useful than front. And again, it just depends on the contract. And we show this on the recommended roll method spreadsheet. So the high-grade copper, HG, traditionally had a different contract cycle than it has now. It was, I believe, HKNUZ. So March, May, July, September, December. However, as many contracts have, and this is actually the case in quite a few, we saw it in Eurodollar before it finally stopped trading, but where for the first 3 months out, you actually see all the contracts. So it doesn't skip for the next 3 months. It'll show some near term trading in contracts, and then those will expire, and then it'll sort of, keep the other further out contracts. So you go more than 3 months out, you only see HKNUZ. So here, what we do see, though, is that these contracts that they added are never as liquid as the traditional contract cycle. And it's the same thing in some of the, as I said, Eurodollar, but there's a bunch of them where HMUZ, the quarters, were the original contract cycles. And they added these interim contracts, but they're never going to be as liquid. So if you just use nearest, you're going to see on the left that you'll roll from March to April. And if you do this, the volume and tick count drop precipitously. And then it picks up again at the end of the month of March. And you can see I wrote this out from the end of, from late February to the end of March. So you could see this. It will roll to the April, and then it'll stay there until it gets to this May contract. And then all of a sudden the volume picks up again. But if you use most active, it skips the April altogether because it doesn't have any higher tick count than the May does. And then it goes right from March to May. And it will do this throughout the contract. So there's an example of where it is more useful to use most active. Next slide. So another issue facing users of historical futures data is the price gap that's caused by these rollovers from one contract to another. There's an artificial price change caused by the differences in the price levels that normally exist between contracts. Generally speaking, but not always, the further out contract is going to have a higher price. And so if you're long and you roll from one contract to the next, you would show an artificial gain in that, but you could show gains or losses in your theoretical returns that would not match reality. And we're trying to emulate reality here. But keep in mind that this affects positions that are held overnight. It doesn't affect day trades. So if you close out your positions before, every day before the close, then the rollover gaps aren't going to affect you because you're going to put on your new position the next day in the new contract, and it's going to be at that new level, and then you're not going to have this artificial jump. So we're really only talking about when you're holding positions and when your analysis is holding a position over one of these rollovers. So these rollover gaps can be removed by adjusting data. Once the roll is established, you've said when you're going to roll, you determine an adjustment value by comparing the last price before settlement. And this is how we do it here. We're looking for a price at a time that can match, where there's a time when we know there's going to be a trade in both contracts. And for us, it's usually the close of the day session, but it's that price right before settlement in both contracts. And we take that price in each contract and we compare them to. Then we apply the adjustment value to all prices before or after that rollover, depending on what your settings are. And I'll show those settings on the next slide. But do keep in mind that these adjustments can distort theoretical returns if applied improperly. So we're going to talk a little bit more about what you're actually doing when you're adjusting. Next slide. So TickWrite offers backward and forward adjusting by difference and ratio. Backward and forward determine the direction of the adjustment, whether you're going to start at the beginning of the file and move forward or the end of the file and move backwards. While differences and ratio determine the way the adjustment is calculated. So if you're forward adjusting, you start with the first contract in a data set and you work forward through the data and you make these adjustments as you go through it. And if you're backward adjusting, you start with the most recent contract rollover and you work backwards through the history. So one thing to note here is that there is less distortion in the recent data when you backward adjust. So people do tend to backward adjust more commonly than forward adjusting. Then there's the determining the way the adjustment's calculated. And here we're talking about differences or ratio. So to adjust by difference, you subtract the back month price from the front month price at this one single point in time. And then you add that price to every previous price in the file all the way backward to the beginning. And if you're backward adjusting here, we're talking. And then you'd go to the previous rollover and you would perform the calculation with the close at that point, and then you would adjust that all the way back. So you're having this sort of amplified price distortion as you go further back through the data. When you adjust by ratio, you divide the front month price by the back month price, and you multiply that factor times every previous price in the file. And then you do the same thing. If you're backward adjusting, you go backward to the previous one and you do the same thing. And one thing when I talk to clients about this, because I've heard in people talking, I've read in a book actually that ratio adjusting is better than difference adjusting. And I do not believe that's true. And that's because they treat the data differently. So I don't think one is inherently better than the other, but it's important to know which methodology is correct for the model or the math that's used in your analysis. So if you are looking at price levels, if you're looking at things like percent changes, if you're looking at where the price level factors into your analysis, to the math that's using to determine when you're going to trade, then you're going to want to use ratio adjusting, because if you are using percent changes and you go by difference, then that price level is going to affect the percent change. However, if you're looking at actual changes in the data, number changes, and you use a ratio adjustment, that's going to distort the data as well. So then you need to use differences adjusting. So I just wanted to make the point that it's important to understand the math that's involved in what you're doing and to determine which adjustment type to use. And then one other thing too, to mention about differences is because there's a potentially bigger adjustment. If you go back 30 years in some data and you make these backward adjusting by differences, you could actually have data that goes negative. And some models don't treat that well. So TickWrite has a function that I think it's the default option actually, if it finds a negative number in any data set that it outputs, it will take that absolute value and add it to every single trade in the file. And what you wind up there is that you actually could see an adjustment in the front month, which you would not normally see. We've had clients ask about that. Why is the front month data adjusted? And it's because TickWrite was adjusting to get rid of a negative, and it just takes a constant and adds it to the entire data set to make sure the min of the data set is 0 or higher than 0. Next slide. So here's an example of adjusting for rollover gaps. Here we're using the CME Euro FX contract, the EC contract, rolling from September to December. This just happened a couple months ago in September. So at the top, you can see the September contract at the rollover, and on the right at the top, you can see the December contract, the U and the Z. The top line, so you can see that you have the 14th and the 15th. We already established that this is going to roll on the 15th, so that's why I'm showing this data. But the data at the top is showing just the day session. So one of the options in TickWrite is you can actually show day session, night session. Now, there may or may not actually be a day session anymore. Certainly for things like the E-mini S&P, there is, because the stock market is open 9:30 to 4 o'clock. And so that is still considered the day session in the contract. But there is this sort of traditional day session. There certainly is higher volume in many futures contracts still. But here, the reason we're using this is because this close of the day session is basically right before the settlement occurs. Even though there is still trading in this trading day afterwards, the settlement occurs here. So what we're showing here, the closes that we're showing are actually the closes of that day session. And that is what we're using when we want to find the value here. So we're adjusting by differences here. And what we're seeing is this, I think is 0.0445, I think is what I calculated this difference at. And so what we've done here at the bottom, you can see on the left is the adjusted file and on the right is the unadjusted file. So here you're seeing the continuous contracts. One on the right is unadjusted, and then the one on the left is adjusted. And so we basically, and you'd have to look closely to see it, but basically the data of that U contract on the 14th is where the adjustment occurs. And so even though, of course, there's a price difference there, that price difference is going to not include the rollover gap. So you still have the normal, price action, but you've removed this rollover gap. And so all of these prices, if you calculated it, all of these prices before the 15th, if you subtracted like the open of one from the same time, the open of the other, you'd see that they all have the exact same difference in there. And that's what the adjustment does. So I hope that's hopefully helpful for talking about how Tick Data does our adjustments. And again, I'm always happy to talk to anybody who wants to talk in more detail and apply what we do to your own analysis and trading. One of the benefits of being a Tick Data client is we've been doing this a long time, and we're more than happy to talk to you and help you in any way we can. I did want to talk a little bit about the London Metal Exchange contracts and the uniqueness of their prompt date rollovers. LME is a very popular exchange, and obviously metals, aluminum, copper, zinc, lead, nickel, tin, and a bunch of others. And so they have a very unique situation where they have these daily expiring, like we used to call them perpetual expiring. They call them prompt date structure. And they're trying to emulate spot trading with contracts that expire today, every day. They also have weeklies, and then they have monthlies that go 3 months out, that are more like traditional contracts. But it is very unique. No one else has anything like this. So the LME data is not compatible with TickWrite 7, but we are actually in the process of building TickWrite 8, and we're working on getting this in there. It is a very different sort of situation. However, we can offer the LME futures data, and we are asked for it quite a bit, and we offer it in the text files provided by our parent company. If you're a OneTick user, they're also available in OneTick archive files. But we have LME data, quotes and trades back to August of 2013, and can provide that, no problem. It's just not in TickWrite, but we can provide it. And finally, next slide, just a few words about data cleanliness and filtering. As I had said before, no data set, historical data set's perfect, and any data provider who tells you that theirs is perfect is not telling you the truth. Our historical intraday data, however, is the cleanest, most robust data available, and I'm always happy to put our data up against any other providers. But here I wanted to talk a little more specifically about data filtering. For more than 20 years, we've employed an algorithmic price filter, and we've used trade condition codes to provide our research-ready data. Back in the day when there was pit trading, you had people who were pit reporters who were typing in the trades as they occurred, and there was a much higher chance for error. We saw many data decimal shifts, numbers being transposed, a 43 becomes a 34, things like that. So we designed and implemented this algorithmic price filter. But over time, and this has been in the last few years, we've analyzed the data, and we've really found that this price filter is no longer necessary. The electronic markets don't have the same issues that data from pit traded markets had, and just in general, data is clear, and this is great. I mean, this is good for all market participants. We still do have our validation. We're looking for holes in data, looking for other types of issues, and we still employ our in TickWrite condition code filtering is still in TickWrite. The data is all there, even condition codes that we think should be excluded, things like block trades and EFPs, things like that, out of sequence trades. Those are still in the data, but TickWrite can filter those, and you just check a box to include them in output, and you can create your own filters in TickWrite as well. But we still do employ them. But we have been phasing out the algorithmic price filter. So that is a bit of information there that hopefully is helpful. Yeah, there's a poll here, Justin.
Scott, thank you so much. At this time, please do use the Q&A button in the middle of the Zoom interface to send us some questions. And also let us know what sort of follow-up you'd like from Scott and his team. If you'd like a meeting, a demo, or some sample historical data, a call to learn more about the support, the file formats available, and some of the more detailed information about futures market data that Scott has and some of the best practices. As you can see, Scott knows quite a lot about the subject area. More than happy to share with you. We have some questions coming in now. First of all, how do you sell tick data? Can I buy it by symbol or by market or by the entire data set? Is there a monthly cost, for example?
So you can actually license data by symbol or by market or the entire data set. We are more than happy to provide the data to you in basically just about for every market, as a la carte as you like. Obviously, the more you license at one time, the less costly per unit it is, but absolutely not a problem. As far as a monthly cost, there is either an annual cost if you want updates, or you license the data, you lease the data, but you can also purchase a perpetual license for data, which is a one-time purchase. And if you're not getting updates, you would just pay with one time, and you would have that data to use forever.
Thank you, Scott. Next question. How far does your data go back? I think you might have answered this during the course of the webinar, but someone clearly wants to ask that question again.
Sure. This really varies wildly. For the futures data, it goes back as far as the 70s. For the trade data, our quote data basically starts January 2010. There are a couple markets that go a little bit before that, but we say it basically starts January of 2010 for that data. I will say that as I had mentioned, there are a lot of changes that have occurred in the data over the years. As we've gone from pit to electronic, we've expanded our ability to include data. As I said, we did quote data. So format changes have occurred. The file format guide, which is available under support on the website, and the futures FAQ, also under the support menu, have details on the data as it is now, the data as it was, and how it's changed over the years. And I strongly recommend taking a look there. It'll answer a lot of your questions.
Thank you, Scott. How is this data different from free sources of data I can download from the internet?
What I've seen, a couple of things. First of all, most free sources of data are end-of-day data, EOD data, which will show you daytime open, high, low, close volume for the day. As far as free intraday data, I haven't seen too much that's of high enough quality, and all I can say is you get what you pay for.
Well, that's a fair assessment of the situation. This sort of data, it's time series data, but can I load this into a non-time series database such as Snowflake? Or is it just, it's such detailed time series data that it has to be in a specialized time series database?
No, it does not. You can look at this data in a text file, and just comma delimited data in a text file. You can view the data in Excel. You can put the data into MySQL, or you could start to get more advanced and look at the data in a Snowflake or in OneTick. OneTick actually, One Market Data acquired us because our data was so ideal for their database. It was purpose built for financial time series data. So it was a very good marriage in terms of the analytics and database platform and the content that we provided. So you really can put it into any data viewer or any analytics tool or package that can handle time series data, comma delimited data, anything like that. It's very straightforward.
Scott, what countries do you cover?
Many countries. It's too many to list here, but if you look on the Tick Data website, you can see the 30 equity markets that we cover, the 30 or so futures markets that we cover you can see in the list of available futures data on the futures product page. And we can provide a list of all of the markets covered by One Market Data, by OneTick, that we can also provide. And it's many more equity markets, probably about 10 more futures markets, and a whole bunch more less active symbols as well.
Thanks a lot. Last question here is, how does this compare to data I already get from Refinitiv?
So a few things there. First of all, Refinitiv obviously is a long-time source of historical data, and they provide many other functions and many other data sets, types of data than historical data. Most of our institutional customers are also Refinitiv and or Bloomberg customers. They're getting real-time data from them. They might have even gotten historical data from them, but they still come to us for historical data because of a number of reasons. When it comes to US equities, which I know we haven't talked about today, but we have exchange source data. Everything in Refinitiv is collected. They're a real-time data provider, so they collect everything. So everything is collected. I have certainly heard of clients coming to us because of data quality issues that they've had. I'm not going to come here and badmouth them or say anything specific here. Just giving what I've heard anecdotally from clients. Certainly from a ease of working with us, we pride ourselves on our support and our sales team really working with our clients to provide custom price quotes and really being able to tailor purchases of data for what the client needs. And so just kind of being easier to work with, I think we have them there. Certainly data delivery options, things like that, we have more options as well.
Great. Scott, thank you so much for your time today and for all the attendees and the questions. As always, to learn more about Tick Data, please visit tickdata.com or email us at sales@tickdata.com, and we look forward to seeing you all on the next webinar. Thanks so much.
Thanks very much. Thanks for coming.